If you have a mortgage and you haven't checked your rate this month, you might be bleeding money right now. Today, I'm Hamid from Wealth Decoders, and mortgage rates just hit 5.62%. The decision you make in the next few weeks could save you or cost you tens of thousands of pounds. Stay right here. Here's what I'm going to break down for you. First, why 5.62% is actually more complicated than it looks. Second, the real data on whether fixers or floaters come out ahead historically. And third, a framework backed by actual research, so you can make the right call for your situation. Not your neighbors, not your mates, yours. Let's set the scene. In January 2026, the average 2-year fixed mortgage rate crossed 5.62% according to Moneyfacts. That's up from 4.74% just 18 months ago. Meanwhile, the Bank of England base rate sits at 4.5%. So lenders are charging a premium, a big premium, and most people don't even realize they're paying it. Here's the truth. On a £250,000 mortgage, the difference between 4.74 and 5.62% is roughly £115 extra per month. That's nearly £1,400 a year. Over a 5-year fix, almost £7,000 gone. Just from a rate shift most people scrolled past on the news. Most people don't know this. Right now, according to the Financial Conduct Authority 2025 Mortgage Market Review, around 1.4 million UK homeowners are sitting on their lender's standard variable rate. The average SVR, a shocking 7.72%. That's over 2% higher than the best fixed deals. These homeowners are overpaying by thousands every single year because they didn't act. Now here's where it gets crazy. Professor Michael Sheres from the University of New South Wales published research showing that across multiple decades and countries, borrowers who chose variable rates paid less over the life of their mortgage around 70 to 80% of the time. That's a game changer. The data says floating usually wins. But, and this is critical, that doesn't mean floating wins right now. Listen, most people look at the Bank of England base rate. That's amateur hour. The pros watch swap rates. Swap rates are what banks use to price fixed mortgages. And right now, the 2-year swap rate is sitting around 5.1%. The 5-year swap rate, 4.6%. That tells you something insane. The market is betting that rates will come down. And coming up, I'll reveal why that bet might be right or dangerously wrong. Here's what changed everything for the fixed camp. Inflation. In 2026, UK CPI inflation is still hovering around 3.4%. The Bank of England's target is 2%. Until inflation is tamed, don't expect aggressive rate cuts. Dr. Silvana Tenreiro, former member of the Bank of England's Monetary Policy Committee and London School of Economics professor, warned that sticky services inflation could keep rates elevated through late 2027. Fixing locks you in certainty, predictability, sleep at night. Let's be real, the floaters have a strong case too. Tracker mortgages are currently available around 4.75%. That's almost a full percent cheaper than the average fix. If the Bank of England cuts even twice in the next year, and most economists expect at least 2 cuts, your tracker payment drops automatically. No remortgaging fees, no paperwork, you ride the wave down and you save from day one. Nobody tells you this. When you fix your mortgage, you're paying an insurance premium baked into the rate. Lenders add a margin above the swap rate, typically 0.5 to 0.8%, as profit and risk protection. So that 5.62% fix? The actual cost of funds is around 5.1%. You're paying over 0.5% for the privilege of certainty. Over 5 years on 250,000, that's over £6,000 just for peace of mind. Imagine this. It's 1989. UK mortgage rates hit 15%. People lost their homes. Now, nobody's predicting that in 2026. But here's the pattern interrupt. Oxford University economists John Muehlbauer and Anthony Murphy published a 2024 study on UK housing affordability. They found that even a 1.5% unexpected rate rise causes a 12% drop in house prices. If you're floating and rates spike, you face higher payments and negative equity. Double hit. Here's the truth. Most people just as fix or float. Wrong question. You also need to ask how long to fix. Right now, 5-year fixes are actually cheaper than 2-year fixes. The average 5-year fix is around 5.29%. The 2-year, 5.62%. That inverted spread tells you the market expects rates to fall. A 5-year fix locks you into a lower rate and gives longer certainty. That's a rare combo. Don't sleep on it. Most of you are making this mistake right now. It's called status quo bias. Nobel Prize-winning economist Daniel Kahneman at Princeton showed that people massively overvalue their current situation. If you're on a variable rate, you'll find reasons to stay variable. If you're fixed, you'll justify fixing again. You're not making a rational decision. You're defending the choice you already made. Snap out of it. Look at the numbers. Here's what changed everything. I built a framework. Ask yourself 3 questions. 1. Can you absorb a £1,500 per month payment if rates hit 7%? If no, fix. 2. Is your remaining mortgage term under 15 years? If yes, the total interest difference shrinks, so floating becomes less risky. 3. Do you have 6 months of expenses saved? If no, fix and protect your cash flow. Simple, powerful. Write this down. Nobody tells you this. You can split your mortgage. Fix half, float half. Most major lenders, including Nationwide, HSBC, and Barclays, offer this. You get certainty on one portion and upside potential on the other. It's called a part and part mortgage. If rates fall, your tracker half drops. If rates rise, your fixed half protects you. It's the hedge fund strategy for regular people. And if you're not considering this in 2026, you're literally leaving money on the table. Let's be real. Before you fix anything, check the early repayment charge. Most 5-year fixed deals charge between 1 and 5% of your outstanding balance if you leave early. On a £200,000 mortgage, that could be £10,000. If there's even a chance you'll move house, change jobs, or need to remortgage, a shorter fix or a tracker with no ERCs might be the smarter play. Read the fine print. It matters. Here's the insane part. As of early 2026, interest rate futures markets are pricing in 2 to 3 Bank of England cuts by the end of the year. That would bring the base rate to around 3.75%. If that happens, tracker mortgage holders win big. Their payments drop automatically with every cut. But, and I cannot stress this enough, markets have been wrong before. In 2023, markets predicted 6 cuts. We got 0. Be careful trusting the crowd. Let me tie this all together. If you're risk averse, have tight cash flow, or a big mortgage, fix, preferably 5 years. Lock in 5.29% while it's still available. If you've got savings, a smaller mortgage, or financial breathing room, float on a tracker and write the expected cuts down. If you can decide, split, half fixed, half tracker. The worst thing you can do? Nothing. Sitting on an SVR at 7.72% is financial self-harm. Here's the final truth. The best mortgage rate is the one that lets you sleep at night and keeps your wealth growing. Don't chase the absolute lowest rate if it means anxiety every time the Bank of England meets. Don't overpay for certainty if you've got the financial cushion to handle volatility. Know your numbers. Know your risk tolerance and act. Because in 2026, doing nothing is the most expensive option of all. If this hit different, smash that subscribe button and hit the bell right now. I'm dropping a video next week on exactly how to negotiate a better mortgage rate with your lender. Most people don't even try, and it works more than you think. Drop a comment below. Are you fixing, floating, or splitting? I read every single comment and I'll reply. This is your community. Let's build wealth together. I'm Hamid. I'll see you in the next one.